Hi, if you're new, welcome to my channel. My channel is all about investments that anybody in the world can make, not just Americans. And I found something today that I think you will love, and I hope it helps you think a little bit differently about investing in the stock market. I think this is the most research I've done for an investment before, and I'll show you what I found. And I also think you've never heard of this company before. And by the way, this video actually took me over a week to make, so if you wouldn't mind, if you could hit the like button for me so I can grow my channel and produce more videos. All right, now let me introduce you to the Middleby Corporation. Okay, so chances are very low that you've ever heard of Middleby before, but I'm sure without a doubt that you have eaten food prepared on a Middleby product, because 97 of the top 100 chain restaurants do business with Middleby. So what do? Well, Middleby manufactures commercial, residential, and industrial grade cooking equipment. So think like fryers and grills and ovens and things like that. And here are just a handful of the customers of Middleby. So you got McDonald's, KFC, Papa John's Pizza, Subway, Starbucks, Domino's. If you've eaten at one of these places, your food was prepared on or in a Middleby product. The commercial market makes up 55% of their revenue, and they have customers all over the world. Now, they're not just in fast food chains, they're also the company that owns these brands as well for the residential market. And this makes up 30% of their revenue. And the remaining 15% is revenue generated from the industrial food processing industry. So they've diversified into 3 different market areas. A big strength of their company is their innovation. Now, it might be boring to talk about the innovation of a commercial kitchen equipment company, but if you haven't worked this out already, I really like boring companies. Now, I know it's not a shiny, exciting company like SpaceX, but if you really like making money, then the boring companies are some of the best investments we can make. And Middleby have been making very aggressive steps as an innovator in their space. Robots flipping burgers, serving customers, making pizzas are all developing and are going to save restaurant chains a lot of money in labor costs, reducing prep time, reducing energy consumption, and improving the reliability of their food standards. A robot will be able to cook a steak far better than you and I could with 100% consistency. They are already the market leader in many different categories in the commercial restaurant space, and this will put them in a very strong position in the future. But we need to talk about the big elephant in the room. If you're from the year, say 2025 or something, and you're watching this, you might not remember, but in 2020, the entire restaurant industry had to shut down. All dine-in restaurants have closed their doors, and many of them will never reopen again. And far, far from their mind is the idea of expanding or buying new equipment. I've actually just listened to the CEO of Middleby speak at the May quarterly update, and he said that at the start of April, orders declined 65%. It's actually been steadily increasing since then, but it dropped all the way down 65%. Now, this wasn't a big surprise considering all restaurants have closed their doors, but luckily Middleby have quite a strong presence in the industrial food processing market. And because food processing has actually been considered a necessary business, they've had to remain open, and they've actually increased production over this period. The CEO, Timothy Fitzgerald, he also said that he expects normality to return to the industry by about the end of the year, and that's what the feedback they're getting from their customers as well. So I think the big food chains will all be completely fine and they'll make a full recovery. Unfortunately, many of the high-end restaurants, well, they'll never reopen because of the really high costs in starting them up again. So I think the short term is going to be really tough for the industry, but over the medium to long term, new places will open up to replace the old ones that closed down, and I think life will just go back to normal. The food industry has been around forever, and it will continue to be around forever. It's not like we're all going to just start cooking at home every night from now on. We're way too lazy for that. So the industry will be completely fine, and it will continue to grow as normal after this crisis. And Middleby actually has a really strong share of the residential cooking market anyway, so they're going to be completely fine. So regarding longevity, I think the food industry is about as reliable as it gets. But I still have to ask myself whether I think Middleby has enough of a competitive advantage to withstand the competition in the space. I think yes, mostly because of the previous CEO, Salim Bissol. Salim came in the late 1990s and he really did turn the business into what it is today. Now, he isn't the CEO anymore, but he is still part of the company as a consultant, which I still think is very important because he really did build the company and they're going to need a lot of his advice and his direction for the future. The company in the early 90s was actually just like a random assortment of everything. They had washing machines and ovens and dishwashers and vacuum cleaners and lots of different things. They actually had over 10,000 different products when they had no real clear advantage in any of these products. It was a competitive marketplace and they just weren't special at anything. Salim arrived and he cut everything except for the commercial kitchen products, which he then turned the company into a specialized commercial kitchen equipment manufacturer. And he made a big effort to focus the company on brands that had actual disruptive technology. Everything had to be better than the competition. And even to this day, Middleby still acquires companies that have a disruptive technology because that is the most important aspect of the acquisition. They are the largest acquirers of businesses in the industry, which has led them today to being the number one in pizza chains, the number one in convenience stores, number one in fast casual and casual dining, number one in deli sandwich shops, number one in steakhouse and seafood, number one in chicken outlets, and number one in Pan-Asian cuisine. The company also dominates specific product categories and are number one or number two in fryers, convection ovens, combi ovens, deck ovens, conveyor ovens, broilers, ranges, griddles, and many others. So although the business and the industry are in a really difficult situation right now, I do think the long-term prospects of the industry and the business itself are really solid. But of course, I want to see that their finances are solid as well. And these are the three key areas to the health of the business. Do they have too much debt? Are they growing? And are they a well-managed company? Now, we want to see the company pass all three of these criteria. And I've developed these criteria by studying the legendary investors Mohnish Pabrai, Warren Buffett, and Charlie Munger. And if you want to know more about the particular ratios that I'm actually looking at, go back and watch my Facebook analysis video where I go into it in a lot more detail. And if you're new to value investing and looking over finances of a business, well, it's okay. You're not going to get this straight away, but keep with it. And the more videos you watch of mine, the better you'll get at this, I'm sure. And if you think this is boring, well, then maybe this is not the strategy for you. But I like to make money, and this has been proven to work over the long term. So let's see if they can handle their debt. So companies with a lot of debt, well, they're planning to try to grow very fast, and it's totally okay if they can manage that debt. But if they're not making enough money, well, that debt just gets bigger and bigger and bigger, and then I think that that company is now at a lot of risk. They might then need to raise more money, and that's really bad for us as shareholders because we get diluted, and even worse, this is how a company actually goes bankrupt. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratio of the business. And I found for Middleby that they are in a reasonable debt position because of their current ratio. This is strong because the short-term debt is easily covered, which is great because the current crisis, they won't have really any issues. Now let's check if they're growing. And we obviously want to invest in a company that is growing, right? But 1 or 2 years of growth, that really isn't going to be enough. We want to see long-term consistent growth. So to check for consistent growth, I look at the book value per share, earnings per share, operating cash flow, and a few little other things as well. Now I want to show you an example of a near perfect growth graph. This is just simply sales, but since 2006, which means this includes the last financial crisis, they haven't missed a beat for over 15 years. This current crisis will be the first decline, but this is as stable as it gets. Just to show you another impressive graph, this one is international growth for the last 15 years as well. When I was doing this research, about now is when I started to get really impressed. Now let's see if the company is well managed. And we obviously can't just go and have a meeting with the execs and the CEO of Middleby, but there are some telltale signs in the financials that tell us that the management are making some good decisions. So I check for cash deployed into investing activities for the business, return on equity, free cash flow, and I check if they've got a dividend. And I found for Middleby that the company is well managed because they are doing most of these things really well. The highlight would be the free cash flow. This consistency gives me a lot of confidence in their management. But maybe they are being overly aggressive with investing. Although they are a cash flow producing machine, they are investing heavily into acquisitions, innovation, and growth. They are able to do this because of their amazingly consistent earnings per share, so they can be aggressive. Normally, I would prefer to see a little less aggression, but it is better that they are acquiring companies rather than just doing nothing and sitting on their big pile of cash. And unfortunately, it doesn't pay a dividend. So if I was to be grading this at school, let's say, and I was a teacher, I would probably give this a C for their management. It's fine, it's acceptable, but it's not perfect either. So is Middleby a good company to invest in? Now, I've actually made some changes with how I determine the buy price for a company. I've actually spent weeks on this project building this new calculator, and I'm really happy with how it works. See, what that previous calculator that I was using couldn't do was adjust for different growth rates over the 10-year period. In that previous calculator, it really didn't show clearly how I wanted to run different scenarios. See, previously I was just finding one buy price, and anything below that was fine, but now I've developed 3 different buy-in prices. The first buy price is where I just want to get my initial investment. The second buy price is where I want to add some more. And the third, well, that's where I want to be really aggressive. I'm going to provide a full demonstration very soon on how to use this calculator yourself. Here's a sneak peek at my newly built calculator. I know it looks ugly, but I wanted it easy to use, and it is. I don't want to brag too much about it, but it is really good. Far better than the last calculator I was using. So here are my buy-in prices for Middleby, and as you can see, the first initial investment will be at $60.28. Now, I was actually able to buy in under my first buy-in price on the 7th of May, and you're probably watching this into the future, but I really hope it has gone a lot lower because I'll be buying a lot more, and I'll be buying more at these prices. Now, the share market might tell me that it has gone up 50% or down 50%, but that's not really important. What's important is the return on equity number has been increasing. And that's the hard thing about investing in the share market. You see the price go up and down, and you assume you've made a lot of money or lost a lot of money just because of the share price. And as long-term investors, we're going to buy a piece of the company, and we want to see our return on equity grow and grow and grow and grow forever. And the share price on the market, well, it will eventually catch up. Benjamin Graham, the father of long-term value investing, said that the market in the short term is a voting machine, but the market in the long term is a weighing machine. Now remember, this whole video is just my opinion, and it's just for entertainment purposes. And I really hope you've enjoyed that analysis of a really solid company. There's not many companies out there like this, so I think this was a real gem. And maybe this will even become a really big part of my portfolio. Please hit subscribe if you haven't done so already, and I'll see you in the next video.